It does take us to our talk of the tape, whether a historically good month will play out that way for investors. Let's ask Adam Parker. He's the founder and CEO of Trivariate Research, a CNBC contributor, with me once again at Post 9. It's good to see you.
Always good to be here.
All right, so new quarter, same story for the rally. What do you think?
You know, we look back, our data goes back to 1928 in our database, and there's been 12 times previously we had double-digit returns for the S&P in 2 straight quarters. You know, we were up 11 and change in Q4, we're up 10 and a little bit in Q1. So I said, all right, well, what happened the quarter after that? And if you look back, the averages, it worked another 4% on average, and only one time were you down double digits, Q3 1975. So the data, it's not a massively statistically significant sample size.
Yeah, it's
but
not
the data,
an exact science or anything, but the trend is your friend. I mean, momentum means something.
It's up. 9 out of 12 times it was up. Only one time was it bad out of the previous 12 years. So history doesn't say, oh, I had 2 great quarters, let me, throw everything out. So I'd say that, the trend's your friend. And I think this week's big. If we get any negative pre-releases, I don't think we're going to, but that's something you got to monitor. Usually everyone dots their I's, cross their T's, and maybe Wednesday or Thursday at 4 p.m. you get a little revenue guide down. That's what we have to watch out for, but I don't think that's, what's highest probability.
So how are you thinking about rates and stocks? Because, you had the better data this morning, and the 10-year goes to 433, and stocks are a little uneasy. I mean, isn't there a point at which stocks don't want to handle the backup in rates once again? We don't want to be talking about that again, do we?
Man, it's like I want to change my mind on that every day. I want to say, good news is good, bad news is bad. If the economy is good, the 10-year backs up a little, the stock market goes up, corporate earnings are good, that's how you learn it in the textbook. It's only in the last 13 years we've all been messed up by Fed intervention that we think it only can be good when rates go down, right? And today it's interesting, the market's, not having a great day, but tech, which you would think is more rate sensitive, is fine. So I think it can handle higher rates as long as I think the economy is decent, but I don't know what the magic cutoff is, if it's, 5 or something like that. But today surprised me a little bit. I think, good news should be good.
You've called the broadening pretty incredible, right, that we've seen in the market. It's been extraordinary, really, that, finally all these other areas beyond tech over the last month, let's say the month of March, I mean, tech was like 6th or 7th in performance. Does that continue?
I think if you're bullish, it will. If the market goes up, it will. I don't think, that small caps outperform in a down tape. So to me, the reason things are good is financial conditions are very easy. If you look at any sort of standard financial conditions index, this is about as good as it gets. It's in the top 5% of easiness. So the small caps shouldn't have problems accessing capital. Their margins can go up, and that's why it's broadened. If you get tighter financial conditions, if the economy slows, then I think you narrow back to the ones you're confident in the growth trajectory.
I mean, I heard somebody use the word Goldilocks earlier, right? Economy strong. We know the Fed's going to cut at some point. Earnings are probably going to be, decent. Is that would you use that word?
Yeah, decent. I think that's right. I mean, look.
I mean, Goldilocks.
Well, yeah. I mean, you had 2 double-digit return quarters. The Fed is, saying they're going to be accommodative. Margins are going up if financial conditions are easy. I think you got to dance when the music's on. I think the question is, does the Fed somehow, really get people thinking look, the worst thing is you start being afraid we have stagflation later this year. You get a little bit of pickup in inflation, economy slows, and then that's where you get the double-digit correction in that month. Right now, that doesn't look like something you should position for, and I think there's lots of portfolio strategy, right? You can own AI, you can own accelerating software, you can own electrification industrials, you can own energy and copper. Like, there's things that I can own healthcare services for cost cutting. Okay. I see lots of things I want to own, and so that keeps me constructive.